Good morning, everybody. Welcome to Phoenix Trading Strategies Free Trading Room. Today is December 26, 2014. It is 9 a.m. in the morning, Eastern Time. For those of you that have never joined us, I want to welcome you. For those of you that have been with us, I want to welcome you back. Hopefully you've had a chance to look over the website and the information that we provide. Today we're going to be showing new things that we've done with the software that will make a difference in your trading. But before we go there, we're going to go over the disclaimer. And here's the disclaimer. Future stocks and spot currency trading have large potential rewards but also large potential risk. You must be aware of the risk and be willing to accept them in order to invest in the futures, the stocks, and forex markets. Don't trade with money you can't afford to lose. This website is neither a solicitation nor an offer to buy, sell futures, stocks, or forex. No representation is being made that any account will or is likely to achieve profits or losses similar to those discussed on this website. Past performance of indicators or methodology are not necessarily indicative of future results. Okay, great. So I want to welcome you all again to the Free Trading Room sponsored by Phoenix Trading Strategies. And today what we're going to be doing is that I'm going to be going over the charts. I'm going to be going over the market analyzer. I'm going to be going over the indicators. And then I'm going to choose a few of you where I'm going to actually remove the mic from, or actually give you the ability to speak and ask a specific question for everyone to hear. So this is going to be very interesting because I've never done it before, but I'm going to do it today because it is my gift to you before the end of the year. So you can ask one or two questions. I will give you each that option. I will remove the the ban on your mic. So if you have a mic, when I do so, I will click to you and you'll be able to ask me a question or two. Okay? So today is going to be a little bit more interesting, but I want to make it as interesting and free-flowing as possible for everyone. So let's begin with the website. As you all know, one of the main reasons why we are all here is because we've discovered that there is a financial war taking place not only on an international level by nations, as you've seen, but we have a currency war in play. We have a war of commodities. But the most important war that affects us all is the war against the retail trader, because you're caught right in the middle of it. And the financial industry, the banks, the market makers, have taken every precaution to make sure that you don't win until now. Why? Because they have taken or made the investment in their financial engineers to basically create protocols to counter-program every indicator out there known to you. And we're going to be going over that. They've counter-programmed candlesticks. They've counter-programmed MACD, stochastics, RSI, Bollinger Bands. They've counter-programmed, good Lord, moving averages. It's amazing everything that you've learned from from Ichimoku Cloud, from we'll go over it, but believe me, you're going to be surprised at how they've done that. But that's okay, because the one mistake that they've made is that when they decided to create aggregator feeds and at the same time import all their data through the aggregator, they're now reporting all their bids and asks, all their order flow. And now we can see that. Now the problem was that before we couldn't really quantify it because there wasn't a specific formula to do so until now. You're going to see that our volume indicator is one of a kind. There is no indicator out there that rivals it. But more importantly is you're going to see that the indicator suite that we have has no rival as well. So we're going to go to the charts right now, and I'm going to show you something which is very interesting. Now here what we're looking at is that we're looking at the pound dollar. And the reason why I chose this currency pair today is because, number one, it was one that was showing a potential trade, which is right here. This is on the 10-minute. Now I'm going to go over the indicators real briefly because some of you probably have seen some of the videos. Now these gold dots are not regular gold dots. These are what we call power dots, and the reason why we call them power dots is because the algorithm that we designed is specifically designed to, number one, calculate the level of price that they're currently trading at, because it's been done historically in the past. But number two, every time that they come out, like you see here, they also identify that volume and momentum are about to come into the market. And that's something that many times we do not know when that happens. So if you now know, for instance, in this case that we're seeing, that they are about to drive volume and momentum into the pound dollar, wouldn't that make the most sense to actually look at a chart? Wouldn't that make the most sense to start analyzing that chart at that specific moment? Because I've always wondered, when is it the right time to look at a chart? And we just changed it right now to the 15 minutes, so give it a second, because it'll take sometimes a minute before it actually converts. Once the chart comes back up, you'll see that maybe on the 15-minute there are no power dots. And so we look at the 10, the 15-minute, and we'll even go to the higher time frames. Now, in this case, there is no power dot. But as you can see, they just broke through the trend stop, which flattened out. There's a pivot here. They bounced off of this level, which was previously identified, as you can see here. And I did it on purpose. The reason why I identified this in the past 2 days is because I knew that they were going to hit these levels. They hit this level again, and now we have another level. Now this next level is important because even though right now it is not, let me tell you something, a day from now or two, if they retrace and come back, they'll hit this thing as if it were the exact moment in time that they needed to. It is amazing how precise they are, how their algorithms are trading according to specific price points, not pivots. Everyone uses pivots. Oh, the banks are using pivots. No, they've counter-programmed against that as well. Now, even though right now we're seeing that they're trying to drive this thing up, let's measure to what level are they actually trying to drive it up. When they bounced from here, the next level should be here, which should be a total of 42 pips. So if they started at 155.40 and they're at 155.63, that's 20 pips. So that means that they've only got another 22 pips to go to the upside based on just measuring these levels. Why? Because they previously hit this level. Now if they do break above this level, they'll come here and maybe even come here. Now liquidity is dry today and was yesterday extremely, because there was nothing, as you can see. The moves were just utterly ridiculous. You couldn't kick someone to move the market, and that's because their algorithms are trading right now. So they don't have real people trading behind the desk as well, but that's okay. Our algorithm is meant to analyze when they're going to start increasing their momentum and volume. Now, since we know that here they started to show on the 10-minute, wouldn't it make sense then to analyze what type of volume they're driving into that? And before we get into that, I'm going to explain now each and every indicator, and then we're going to get to that level. Now, as you can see, these candles, there is dots trading between them. Now these are trend dots, and as you see, if they're bullish, they're turquoise. If they're going to transition, they go gold again. Not to be related to the power dots, I actually have to change that color. If they transition to bearish, as you can see here, they will turn red. These little dots here are actually crosses, and I'll increase the this level here so you can see. They're actually crosses, but they look like dots, plus signs. And this is a trend stop. So the minute price breaks through it, then basically it changes the trend, of course. Now here, for instance, we're seeing that they broke through this price. We broke through the previous day's high. So it's fair to assume that they're going to continue long. That's what's fair to assume, because they've already started in that direction. So they have to finish it, plus the fact that they bounced off of this level previously. Now that we understand what these are, the power dots, as I said before, come out only when they're going to drive volume and momentum into the market. This is when it becomes very crucial for you to actually come and see the charts. Now the nice thing is that you can actually program NinjaTrader through the market analyzer that every time, as soon as the power dots start to appear, you can get an email. So you don't have to be looking at the market or looking at the charts, depending where you are, of course. For instance, here, this power dot actually formed. The first one formed at 12:45 my time Pacific, which is actually 3:45 a.m. Eastern time. Now, as you can see, it took them 1, 2, 3, 4, 5, 6, 7, 8. So you had basically 2 hours before the actual move took place. Now, I didn't like this setup. I like these setups right here. What's the difference between this one and this one? Whenever they're trading around a specific price level, if you see that the power dots form between 9 and 15 pips away from the candles and the level, then you know that that level or that price level will not be broken by price action. They will not drive candles below it. They'll bounce off of it, but then they'll drive it up, which is exactly the case here. Even though they had breached it here, they went up, they came right back down, retested it, but never broke below it, and then they drove it up. This trade would have been worth, from here to here, 30 pips. Really not a lot, and that's all that it gave yesterday. However, we were able to catch it with our software. Now here it gets even more interesting. This is where it becomes really unique, because, as you know, when these power dots started to form, you had plenty of time, but realistically you only had about an hour before the trade actually took place. And then they continued to form, meaning that they were going to continue the momentum in that direction. Here, for instance, even though they formed here, price action was coming at them. And the dangerous part about that is that it would eventually break through. So what I'm going to show you when you buy the software is that I show you how to differentiate this trade from this one. And I teach you that this is the most important trade of them all. And we'll see them, because sometimes, as you see here in this one, they were driving price action directly to it, and then they broke through it. But this one right here formed at the same level as this one did, as you can see, but the dots formed right at it. They never came and challenged it and came down, and then they went up again. So some of you may say, well, that looks like a counter trend program. It's not. It actually calculates the most conservative trade that you could take, probably the best trade that you could take. We trade within probabilities, and probabilities are what make the difference. Now this indicator is a sentiment. It really works as a heat map. I call it the Phoenix sentiment, because it's telling you the sentiment of price action in the market. So in this case, after they became bearish, as you can see, the transition here was nice. It became bullish, and then it really became bullish. The brighter the color, the more bullish the strength. Now here, as you can see, you couldn't really tell when they were bearish. You know, you could tell that they were slowing down, but then they got really aggressive because they broke below it, and then they just changed. So couldn't really rely on it. And I don't use it as a leading indicator. I use it as a fourth level indicator. This one actually has more importance to me than this one. This I call the Phoenix radar. Now sometimes when they're trading together in line the way they are here, it's basically showing you that they're trading in balance with one another. So they haven't been taken out of balance. As you can see here, for instance, the pound got stronger, the dollar got weaker, and you saw this big move here. Here they took them out of balance. But then they rebalanced them again, and here they strengthened the dollar, weakened the pound. Not a big move, but it does help. Here you can see that they're weakening the dollar and strengthening the pound, and that's why they're starting to drive price up. But when we were at the 10-minute, these dots were about right here, and you can see that price was aggressively going directly to that. And right now, now that they've broken them, they're really going to they should go to the upside, and they should go up another 20 pips. Now we go to the volume. This is the volume, and what makes the difference between this volume indicator and everyone else's? That this volume indicator actually shows you something that none of the others can't. This one shows you the exact amount of order flow that they're pushing into this. Now this is a retail feed. So on a retail feed, every tick is worth 100,000. On an institutional feed, every tick is worth 1,000,000. So here they've pretty much watered it down. So on this specific candle that we're seeing right here, you can see that when they came down to this level, they dumped all their shorts, and basically they dumped 133 million. But they bid up 187. So there was still 54 million in orders that could not be filled, and they drove it up. This candle previous to it, they basically shorted 52 million, and they bid up 74 million again. So this is a bearish candle with bullish volume. Now here, it would not have made sense to analyze that. Here, for instance, we're seeing that there are power dots on the 10-minute. And so here, you can tell that they're live right now on the live edge of the market. They are offering 41 million on the short side. They are bidding or buying 58 million on the long side. There's a difference of 19 million now, 59 million on the upside. So we're seeing that there's a net difference of 19 million on the upside. There's 60 million now, and 40 on the upside, 42 million on the downside. Now, for this amount of volume, is it fair to say that we should see more price action here? We should, and yet we're not seeing it. Yet this previous candle here, we're showing that they offered 54 million on the sell side and bid 72 million on the buy side, leaving a difference of 18 million. And you saw price action there, a little bit more aggressive. Here, they're holding back. Now, whenever you see that they're dumping this type of volume, they're putting this type of volume, but they're holding, two things, it can signify two things. Number one, especially from a previous candle like this, that they're actually not going to breach this level any further because they're pulling back. And it's not based on the candle, it's based on their volume. So unless we see price action aggressively drive through this level, what this will mean is that it will reverse. That's why those power dots are very important. The only thing that I did not like about the power dots forming on the 10-minute here is specifically that you had price action going to it too aggressively. And when it goes to it too aggressively, it's a trade where it does not seem to be that, how can I say this, the probability is not 100%, because at any moment they can break through it. Now here, for instance, they pulled back. So this is where it becomes interesting, because now that they've pulled back with the amount of volume that they dumped 63 million on the buy side, 48 million on the sell side. So there's a difference of 15 million in orders that could not be filled. But in the previous one, They put in 54 million on the sell side, 72 million on the buy side. They had 18 million on the buy side that wasn't filled, and they still drove price action up. So what this means is that this could have been the last hit to the upside, and then the reversal. That's where the power dots come in, because the power dots will tell you and identify that price level that makes sense. And that's the price level that sometimes you're not aware of, because many people would say, well, wait a minute, that could have gone up to the other level, which is right here, to 155.83. You're right, it could have. No one is saying that it wouldn't. Why? Because it has all this room to move. However, if you can see, the previous day's high was right here. The dots formed right at that price, 55.63, 55.64. So they can also use that as a resistance level. But I've shown people not to take this trade to the upside when the dots form because of that. Because sometimes you don't know if it's going to break right through it or if it's going to bounce right from it. And the only reason why I don't like those trades too much is because the power dots and price action are too close to each other. If I would have seen the power dots form up here, which is 5-10 pips away from here, I'd be telling you, you know what, this is going to go short. But it didn't, and because of that, I wouldn't take this trade. I would avoid it like the plague. However, this one, I'd be all over this one. I'd throw the kitchen sink at them and my mother's with ice so that it really gives them a chill. What's the difference here? I'm going to show you the volume level here that they pushed. Look at this. This is a candle previous to this one, but I want you to see, because they hit this price level, which was 155.29, and it's a very important price level to them. Or is it 156.29? My eyes. No, it's 155.29. Forgive me. So here, for instance, this in this candle, they offered on the sell side 114 million, and they offered on the bid, or they bid 168 million on the buy side, with a difference of 55 million. So this is so I'm telling you right here and now that this specific candle that we're looking at, this one right here, is bearish with bullish volume. Wow. But more importantly, what I'm trying to tell you is that what they do here is what I call currency portfolio rebalancing. They're rebalancing their risk, so they're getting out of their shorts. Let's go to the next one. Look at this one. It's a bullish candle, but I want you to see the difference. They offered on the sell side 158 million. And bought 190 million on the buy side, a difference of 32 million on the buy side. It is a bullish candle, granted. Do you not think that this candle should have reflected more volume than this one? It should have, but it didn't. Why? Because they're still trying to rebalance and get out of the shorts before they drive it up. The next candle. This next candle was on the sell side, 131 million. On the buy side, 157 million, a difference of 27 million. Yes, granted, they drove it up to this level, which was previously identified. They came right back down, never violating this one. But let's see the volume here on this next candle. This was 155 million on the sell side, 123 million on the buy side, a difference of 31 million on the sell side, which was negative. However, it was more of a bullish candle than it was bearish. But then they pulled back a little bit. Not too much. What was it? 8 pips on this one. What was the price? Or what was the volume in this one? 147 million on the sell side, 109 million on the buy side. Why is this important here, as the volume that was displayed here? They never challenged 155.29. They traded here, same amount of volume. You would have expected them to drive this even further down, but they didn't. There's where it becomes interesting. Look at this one. They dumped 181 million on the sell side, 153 million on the buy side, with a negative of 27 million. So wait a minute. That's a bullish candle with negative volume? No. What it means is that they could not fill 27 million that was left on the sell side because they were getting out of their short positions and drove price up. And then of course it just becomes even more interesting because they continue to drive price up. Now here they drove price down because of the power dot, so they're going to come back either right here to this level 155.50, or they're going to come right back here 156.41. We'll see. It'll be very interesting actually. But let's see the volume here though. The volume here right now is 39 million, 40 million on the sell side, 22 million on the buy side, difference of 18 million. So on the live edge of the market, you can actually see the volume here, or you can see the volume here on the bottom as it's forming. But here we're seeing, but wait a minute, this one's telling us that the pound is strengthening and the dollar is weakening. Well, that's yet to be seen. Like I said, we use that as a secondary indicator, never as our primary indicator. Our primary indicator is volume and price. Those are our primary indicators. So now that we've gone over this, let's go back to the 10-minute on this specific currency pair. Now, mind you, I'm only using one chart because I have the market analyzer, and I'm going to show you the market analyzer in a minute. And this is where it's going to get really freaky for you. So pay attention. Let's give it a minute for it to form the chart. Hopefully you've had your coffee this morning. If you haven't, it's a good time. Okay, now we've seen them form here. So as you can see, they formed here. What was the difference? 3 pips. 3 pips is not enough for me to say it's going to bounce back down. So I would have stayed away from this. I like a difference of minimum 5 to 10 pips. If I don't see that, I try and avoid the trade. Now, if I would have seen here, which I did see that they pulled back, I probably would have gotten into this next candle and taken it down. But more likely they're going to come, like I said, to this level, which is 155.48 from 155.61. Not bad. Everyone's expectancy would be for it to come down to this level, which is 155.47. Why? Because it's going to hit on a collision course with the trend dots. So not a bad trade. We're talking 20 pips, but for me, it's too much risk for 20 pips unless I can find a how can I say this? Unless I can find a trade where it's going to yield me a little bit more and the risk based on the power dots is less, then at that point I will look at it differently. But in this case, the risk was too high, and I'm not interested when they're trading this close. Like here, you know, they never really challenged it. They came close to it, but never challenged it. So you could have chosen an entry on the next 2. This one they didn't give us much time. They basically came here and pulled away. That's why I say I didn't really like this trade per se. This one I would have been all over, because it formed on the 10-minute and the 15-minute. And on the 15-minute, the candles never even came close to it. On the 10-minute, they did. And why? Because they were trading around this price level, and so eventually they drove price back up. But we analyzed the volume on this price level, on here, which would have been relatively the same. So now, you know, is where it becomes interesting, because now that we've understood what has happened here, now we can go to a different currency pair. Now here's a market analyzer, and some of you already have this and some of you don't. For those of you that don't, you will. For those of you that have it, here on this row, what it means by congestion is, for instance, they're trading within a congested period between the power dots and the trend stop. Now, wide bars signify these purple bars, and that means that there was a high frequency bar. That's what the wide bar means. So every time you see a bar go purple, it means that they've dumped such a huge amount of volume, and I'll pull it out for you so you can see. On this specific bar, they put in 71 million on the sell side, 38 million on the buy side, difference of 32 million. But it was high frequency, so they put it in very aggressively. Sometimes it will not reflect what you see in the bars closer to the price levels, and that's okay. That's just something that happens. You know, it is what it is. Now, let's go back to the market analyzer. Over this last week, my software developer and I, we were working on this to try and basically make it better. Now, I've changed this here. Every time the power dots form, it will not say analyze me. It will say trade with me, and it'll actually voice itself out on your computer. Whereas price to congestion is basically to these congestion dots here, which are the trend dots, the trend stop. And that will say analyze me. Why? Because every time it gets to that level, it pretty much will guide you to analyze it. And if you want, you can remove that feature or not. Now here I have it on the 30-minute. But I can change that feature. Let me change that out because I hit the US yen by accident right now. So that's okay. Give it a second. And the US yen will come up. You know, there was nothing on it, but that's okay. I'm going to show you that once it populates, that we can actually change the time frame in the market analyzer. Here, for instance, okay, so let's just look at this for now. Earlier this morning at around 2 a.m. my time, well, it actually started at 1:40 a.m. my time, so this is about 4:40. They started to let you know that they were going to drive it up. Now there's nice distance between the power dots and the candles. They went up, hit, came right back down, never challenged the power dots, ever. Continued, and finally broke. They made the break at around 4:30, 4:40 my time, which is 7:40 a.m. Eastern time. Not a bad trade, you know, the way they drove it to the upside. Give me 1 second. We'll see here. So far it's 15 pips to the upside. Not too bad. It's interesting. Now, I'm going to give you guys time to analyze this, and I'll be right back, okay? Give me about a minute or so. Okay, I'm back. Now, this one's interesting, and we'll see why. Number one, you see how they started trading around this price level, and then they went up. Now, there were no power dots here. This is the 10-minute. Does not mean that you won't find them on the 15-minute. However, this line was placed because they originally did it on the 60-minute previously. So on the 60-minute, this level was identified. That's why you have this red line here. And they used it specifically to trade around it. Now, why is this so important? The algorithms that the banks have designed right now are very clear on how they're operating. They're choosing specific price levels or price points, like in this case 120.18, where they will bring price action directly to it but never necessarily break it if they're going to be bullish. Why? Because they're going to use this level to induce, trick, manipulate price action and volume to actually get retail traders to short it, when in actuality they were planning on going long. Look at how long they did this. This is a 10-minute. So basically, as soon as they brought it in here, you could basically say that 1, 2, 3, 4, 5, 6, that's an hour. 1, 2, 3, 4, 5, 6, that's 2 hours. 2 hours and 10 minutes, 2 hours and 30 minutes before they actually started to drive it up. So for almost say 2.5 hours, they were trying to trick people on going short, but they didn't. Would we have taken this trade? Not necessarily. However, we would have used it as a precedent for this one, because this one was more important than this one. Why? Because the power dots formed at a higher price point than this, making it now a completely bullish market. And because of that, we would have thrown the kitchen sink at them here. Granted, it's only 15 pips, but it would have been the safest 15 pips that you could have chosen to take, because the probability was extremely high based on the fact that they drove price action to the upside with candles, and the volume also was settling above this level. What's the difference of distance between here and here? I'll tell you right now. And this is where it gets really interesting, because many times as traders we don't pay attention for it. It was only 5 pips. But 5 pips of a difference on a slow market is one thing, but on a very volatile market, you could see a difference of 10, 15 pips from this line, which would have made the difference for you. And this move, instead of being 15 pips, would have been 45 pips. So these are the trades that we look for. I could care less about this one. And this one, I would take it myself only because I understand what they're doing at this level. And the fact that they're doing it at a level where on the 60-minute it plotted tells me that they were never interested in violating this price. So yes, I would have taken this trade to the upside. And you will too, later, not now. Why? Because right now I want you to learn how to take more conservative trades. This would still be considered an aggressive trade because you don't have the power dots. Now, if we would have had a row of power dots right here, I would have told you throw the kitchen sink at them and don't even think twice about it. Why? Because they formed here and price action was basically trading around this price level, which was never going to be breached because it was previously formed on the 60-minute. So let's go to the 60-minute on this. Give it a minute. And as you can see, we're only using one specific chart right now, and we're changing all the currency pairs within that one chart. And we will do that because with the market analyzer, we've been able to basically make those changes. Now, with some of you that I've taught, how to use the software, I've made you actually open each individual chart and plot the lines there, which is not a bad thing because it actually makes you identify the levels from a better perspective. The more practice, the better. Repetition is usually a good thing. Okay, so here on the 60-minute, we basically drew these levels. Let me erase this one so it didn't come out more. Now, as you can see, this one was formed way in the back, right here. Right here was this bad boy. Now there's another level right here, but it's not really a level because they broke right through it. But they will eventually come to it. So what we did is basically go back in time, and wherever we saw these levels, we would identify them. Now the ones that don't show the power dots are probably on the 30-minute, and we'll go there too. But let me erase these so we can see clearer. But as you can see, we identified these levels based on that information. Let's go to the 30-minute. What I'm showing you is really insider secrets here, because many of you never really pay attention to this. And that's something that I would like to say is something that we've just been taught differently. You know, sometimes we don't look at support and resistance the way we should. Now that we're paying attention more to it, it makes more sense. But as you can see, if those power dots form in the higher time frames, they're highly respected levels of price. Here, for instance, on the 30-minute, you see how this one had formed on an earlier time frame, but look at that. As soon as the power dots formed here, right below this price level, which was right, in this level, I mean, they literally started to go up. No questions asked. If you measure the distance, and we'll measure it, from here to here, I'd like to say that it was 6 pips. But from the main price level, it was 18 pips. Now, as soon as these formed here, and this formed at around, they started to form at 6:30 a.m. Eastern Time. But as you can see here, they started to initiate the move at 7:30 a.m. Eastern Time. Now, I would have felt myself more comfortable as soon as I would have seen them break this price. Here at this point in this candle, as soon as it broke, I would have probably taken this trade. What was this trade worth to you? Let's say you would have gotten in here. This trade was worth 51 pips. Much more conservative. On the 30-minute, whenever you see them plot, and you can change the market analyzer to notify you on the 30, the 15, the 45, the 60, hell, the 120-minute if you want. You have that option. I like the 30-minute because every time I see them form on the 30-minute, then I can scroll down and look at the 10 and the 15-minute and say, okay, this trade would have made sense. But I made a mistake. I should have drawn a line on those dots. Normally when you see them, you can draw a line where they formed, and then you can go to the lower time frame. So you can always know that that is your point of reference. Very important to have that point of reference. Well, we're going to the 15-minute right now on this specific pair. Now I am going to open up the trade forecasting this month of January for you guys to see. So that one here was right here. So here's where it had formed. But you can see they formed here as well. And then they formed here and basically just drove it. So let's draw that point of reference here, for instance, because I think it's important. It was actually about right here. No, it was here. Yeah, right here. This is where it formed. And let's give it a little bit more color. Okay, so we know that this is our point of reference. So we're on the 15-minute. We know that they formed here, and we'll draw a line there as well, which basically confirms. Now they did it earlier here, which is not a bad thing, but the 30-minute was the one that had more value. And now we'll go to the 10-minute. And I'm showing you guys this because I think it's very important. This has really been one of the key components of how we designed this, because we designed it for it to be user-friendly. We designed it to eliminate uncertainty and fear. Why? Because as traders, we fear uncertainty. And because we fear uncertainty, we will not trade. So let's go back to that because it's a good example right here. Okay, so here we didn't have anything form on the 10-minute except here previously. And they played that game, but the fact that this formed below it and then this one formed below it made it even stronger. And then of course they drove it up. Good example. But we look for this type of distance from this price point to the power dots to this price point, even though this was the granddaddy of them all, because on the 60-minute, historically, this was a very important price point. The higher the time frame, the higher of the importance of that price level. So 120.18 is something that they look for aggressively to trade around. And as you can see how that price, they came to it, never really addressed, I mean, they came right back down. Look at it, they never really came directly to it. And as you can see, always trading around it, always, nothing, not even close, maintaining. Then they finally came down, and then they decided to go right back up. Why? Because of its importance. And that leads us to this right here. So you see how important this price level was, that they were never really going to challenge it unless they were going to use it as a point of reference. Number one, to induce and trick traders. And number two, to offset their trades, their short positions, because they were really intentionally going to go long. Now, you could have seen this thing coming here on the 10-minute because you can see how they were devaluing the U.S. and strengthening the yen, but nothing happened really here. And then they started to really kill the yen and increase the value of the U.S. dollar, and you saw action. That made a difference. But we would have taken the trade here before we would have seen more devaluation of the yen. And here, for instance, you couldn't really see anything, but it didn't matter. Because even though they had literally stopped or basically created a level of congestion for price action, we knew the play, especially when the dots formed, that they were no longer going to come down and breach this level because they had achieved what they were looking for, which was to get out of their short positions. And that now they were going to take a bet long. So when they made this move and came right back down, a lot of people said, oh, now they're going to go down. These price levels that you see are what a lot of breakout traders use, and now the breakout traders are the ones that are actually losing because of that, because they are not breaking out from these levels. They're using them to trick them. We don't care because we know what they're doing at these price levels. We know that they're using them as a point of reference, and we can identify it with how they're using it with price action and the volume. Now, these dots also gave them away, and these dots are actually pivots. They're reversal bars. But these are pivots that we call them pivots because that's really what they are. So does it mean that we're using them as points of reference? No, it just means that they are aggressively defending around this price level, and they will not break through it. So each pivot here told us pretty much that, nope, not even close. And look how they drove price action aggressively high. Every time they came down, boom, aggressively to the upside, because if the algorithm drove price action below this level, guess what? They would have to come down because every other algorithm out there would catch on to that. And then they'd have an aggressive push of sell orders to the downside. And so the market maker that actually wanted to drive this up would not be able to because he'd have everyone going against him. That's the difference. This is where it becomes very crucial to understand these price points and understand that when the power dots form around these price points, they are literally the roadmap to the trade. That is what we're providing you, is the actual roadmap of the bank's algorithms. It doesn't get any better than that. Now, let's go to the market analyzer. Now, the market analyzer, here I have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 pairs. I don't need more than that. Now, I have that on the 30 minutes, so we can, and right now it's hitting this one. So let's go look at the Euro New Zealand. Now, with the market analyzer, I can identify that there's 1, 2, 3, 4, 5, 6. 6 pairs that are in play. How long did it take me? A minute to determine that there are 6 pairs that I can go look at, analyze them, and determine if there's a trade on the 30-minute. Let's take a look. Let's go to the 30-minute and see if we would have caught any one of those trades. The beautiful thing about, technology is that it allows you to do many, many wonderful things. And in this time and day, we need every asset of information. Now here on the 30-minute, it basically said that there were power dots, but I don't see them. And so, since I don't see them, and I saw that they broke right through this, I'm not really trading against this downtrend because I don't know where it's going to end. Now, I can go down to the 15-minute and see if there's anything there, but I doubt it. Came down so aggressively that I don't think that I would have taken that trade. If I would have had the power dots, I would have been golden. That would have been a really nice trade to take to the downside. Give it a minute. There. Nothing. There's a pivot, but doesn't give me a lot of assurances. And I don't think I marked this specific chart. I'll have to look at this one. We'll have to go back on the higher time frames. But the move was pretty aggressive. I wish I would have had power dots on this one. Sometimes certain pairs you won't get them. It's just not the time. They're just not at certain price levels. An 89 pip move. Nice. We'll probably see it in a different pair. They did form here, but as you can see, they went right through them. And when you see them actually come in at a steep angle, you'll see price action or the candles trading below their trend dots, which is not a good thing, coming at them aggressively. And you'll see the trend stop coming aggressively as well. So this one's the one that you sort of risk, because here they used it as a specific support level, and then they went long. They came back short, never really going below it until they decided to really come at it, and they came at it very aggressively. So you could have used it as a point of reference, but I choose not to. Let's take a look at the 10-minute again on this one, and then we'll take a look at another pair. So where are we going to go with oil prices? They just do not seem to want to bounce. See, on the 10-minute, you really didn't have anything. And that does not give me great satisfaction when I see a trade like this. Because you could have made the decision based on the fact that it was just coming down, and then, or here, for instance, and they never challenged and just kept going. But I like to see the power dots. If I don't see power dots, I'm not interested. All right, let's go back to the market analyzer. So we took a look at that one, the Euro New Zealand, and probably is saying that because it's close to the trend dots. But I want to show you something. We can actually change the alerts right here. Actually, hold on. Properties. So here, for instance, sort seconds. What was it that I changed it? Template, load. No. Send to FX chart, level times sale, no. Columns. Oh, here it is, in columns. So what we do here is that we have to change each time frame here. You can change it to be on a 10-minute, for instance. And you got to change each one. Oh, forgive me. Got to go all the way up. So on each one, you can modify it, which is a beautiful thing. And so instead of giving you the alerts on the 30-minute, if you want it on the 10-minute, then you can do so on the 10-minute. So it allows you to make adjustments. See, now we have it on the 10-minute. And now, of course, everyone comes up, which is not a good thing. So now you have 12 pairs to look at. This one here, pound New Zealand. Let's take a look at the pound New Zealand. I'm thinking we're probably going to see something better on the pound New Zealand than what we did on the euro New Zealand. And sometimes when you don't have congestion dots or power dots form in one pair, they'll form in another, which are very similar to it. And then you'll say, oh wow, so this was a trade to take. And that makes a big difference because I like high probability in my favor. Forget the high probability in their favor. Now here, for instance, this was the trade to take. Perfect. We didn't get it from the top, but because we had already drawn these levels, number one, we knew that the previous day they literally bounced off of this level, which was on the 60-minute, and they bounced off of this level, which is on the 30-minute. And then they came down. Of course, they opened and they came down. This was a previous price level on a 15 or 10-minute, and that's okay. What's more important is that the power dots formed here, and this was midnight, my time, which is 3 a.m. Eastern time. So if I would have gotten the signal on the 10-minute here, I would have looked at this, and if I would have seen, as soon as them trade below this level, I would have been all over that, and I would have thrown the kitchen sink. Now let's measure this. From here to here, we're talking 47 pips. Now, you're saying, but we missed an 89 pip move. So what? I want assurances. I want guarantees. And if I don't have a 100% guarantee, I don't take it. If I know that they're going to come right down to this level, and they're proving it, what was the difference of this trade and the other one? Let me explain it to you. Number one, it opened low. This was a level right here that you should have been looking at. One, you draw a line. This was a level you should have been looking at. So when you measure, you go from this little pinky to this little pinky, you had 23 pips difference. But this little pinky formed below this little pinky right here. And because it formed below this level, guess what? Now it validated that they were no longer going up here, but that they were going south. So as soon as they broke below this little level right here, which we're going to call pinky number 3, then that's where you throw the kitchen sink, because this is where you have assurances. And you could take a look at the volume now, because now it makes sense to look at the volume. What did they do with their volume? So like I said, I like to have assurances. I don't like to lose. Now here on the 10-minute, not really a whole lot of volume. 1.8 million on the sell side, 4 million on the buy side. On this one, 6.1 million on the sell side, 3.6 million on the buy side. You know, it was more negative. Here, 8.9 million, both on the buy and sell side. This next one, 1.5 million on the sell side, 5.8 million on the buy side. Not really a lot of volume. Again, it didn't matter. Sometimes they've already rebalanced here, so we don't care, or here. So they may not be doing a rebalancing act here. They'll just drive price action down. So this was a more conservative trade, and this is a trade that we look for. This is a trade that makes sense. Now, see how the power dot formed here at this distance from this candle? If on the next candle, this one, look at it, opened below here, then I would say this is going to go down one more time, not go up. Why? Because of the distance. So this confirms, look, it formed here, and now at a lower level than this previous one. So even if you would have missed this trade, you could have gotten in this trade down and would have signified 20 pips. Again, this is the trade that we look for, not this one. This one's too aggressive. These are the trades that we look for. But if the market analyzer is telling you, hey, take a look at all these, guess what? How long did it take us to analyze this? It didn't take us more than 5 minutes to make a determination. And that makes a big difference. If it doesn't take us more than 5 minutes, then we don't need to look at anything else. But let's take a look at another pair. Let's look at the euro pound, for instance. Give it a minute. It's because of GoToWebinar that this is taking so long to populate. Okay, excellent. This one has more lines, of course, and we can actually eliminate some of them because we don't need them. Now here, for instance, at the open, again, 60-minute time frame. This line, very important to them. They came in, they traded below, came down. No power dots on the 10-minute, nothing. I wouldn't trade this at all. You couldn't pay me to trade this. If I go to the higher time frame, maybe we'll find something. And the higher the time frame the power dots form, the more validated that move is. And that's important to know. The higher the time frame, the more valid the move. But if you know, number one, the time that they're going to move the market, here, nothing. Didn't really make any sense. No power dots on the 15-minute. I would have missed this trade. They formed here, but I would have really not paid attention to it because I would have looked for them up here. Let's go to the higher time frame, the 30-minute. Like I said, there'll be certain trades that you miss, but there'll be those that you'll take, and the ones that you take are the ones that make more sense because you're looking for assurances. You're removing fear and uncertainty, and I'd rather take 47 pips that I know I'm going to take over 89 pips that I'm unsure of because I can add more positions on the trade where I know I'm going to hit the 47 and make more. Now here on the 30-minute, it did form. So on the 30-minute, I would have taken this trade and literally thrown the kitchen sink at them. Like I said, sometimes you may not get it on the lower time frames, but when you get it on the higher time frames, there is no questioning. You go and you take that trade. And this was not a big trade. This was only 28 pips, but it was the most conservative 28 pips that you would have picked up on. And that makes a little bit more sense because, very simply, think about it. It is a trade that normally you would have missed if you would have been looking at the smaller time frames. So the higher the time frame, the longer the trade, but the more conservative the outcome in your favor. And that makes much, much more sense. So if you have the market analyzer on the 30-minute, which is what I like to do, if I see that they're forming on the 30-minute, guess what? And this was on the Asian session. So this specific trade took place, and I'll show you right now. This trade started to form literally at the open, at 5 o'clock, but it really took place at 3 o'clock. No, at, let me see, 20, 21, 22. So this was 3 at 4 o'clock. At 4 o'clock, this trade took place at the Asian Open. 4 o'clock my time, 7 p.m. Eastern time. 7 p.m. Eastern time. That makes a big difference. Yes, I would, at the open, I get a trade like this at the open, I'm taking it. I'm not even thinking about it any further. I'm just taking it. You can put a trailing stop. If you know that they're going to hit this level, then you put a limit order to limit out, or you just let it ride and put a trailing stop and let it go wherever it's supposed to go. This is not complicated, ladies and gentlemen. This has been simplified for you. The only thing that we're going to do is that we're going to map out where these power dots have formed, and that's where we're going to identify these levels so that when the power dots form again in the present, then we know, hey, this is a price point that they are extremely fearful of. And we use that term very strongly, fearful. Why? Because if their algorithm decides to break to the upside on this, guess what? Every algorithm will catch on to that and they will drive this price back up. If their intention was to bring it down, they will not show their face here. They will be very respectful. And who they will trick is the retail trader. But now you're no longer going to be tricked because now you understand that whenever these power dots form, it's your trade, not their trade any further. And for me, that makes a lot more sense. So if you can find these trades during, the Asian Open and you're here in the States, guess what? You finally have a life. You can sleep. And that's what I do. Now, if you're in Europe and you want to trade the European session, then yes, you'll find trades during the European session as well. And that's great too. Now, if you want to trade the Asian and European session to make your money, then you do so. The US session, sometimes the moves have already taken place and there is nothing. So basically, if you're just concentrating on two sessions, you should be making money. You should be making pips. Bottom line, the software is not complicated. The software is meant to guide you and tell you the roadmap of the trade. That's it. Bottom line. Nothing more, nothing less. Let's take a look at another one. And here, actually, we'll go back. Well, we won't go back to a 30-minute. Actually, we'll see if there's anything here. Let's see the euro yen. This one's starting to flash. And whenever they flash yellow, it means they're in play. So we'll give it time to populate. We put it on the 10-minute. But like I said, for me, I like the trades that form on the 30-minute. If I get an alert on the 30-minute that the power dots are forming, I mean, there's, it just tells me, number one, that the longevity of the trade is stronger, and number two, that it's a trade that I should be concentrating more than one forming on the 10 or 15-minute. Okay, so this one is the euro yen. Now, on the 30-minute, nothing. Wouldn't have really taken this trade. Maybe I would have analyzing this here, that, it formed twice. Now this trade here, the fact that it formed twice, I would have thrown the kitchen sink at them, especially at this level. But I didn't see the formation here, so it wouldn't have made sense. And there was nothing here that would have told me. Now if I go to the smaller time frame, and let's go to the 15-minute, see if we would have seen anything there, then that would make a difference for me. So hopefully you can appreciate the science of the power dots. Give it a minute. Okay. Now here, for instance, nothing on the 15-minute. They formed here. I would have looked for them to form here. When they formed here, yeah, you could have gone up, but a lot of risk each time on this one because this is a 30-minute level, this is a 30-minute level. No, this is a 60-minute level, actually. These are 60-minute levels. Very aggressive. I wouldn't have liked it when it formed here. It wouldn't have attracted me. Let's see if the 10-minute had anything, and I don't think it did. But you see how the lines that I've drawn stay with Power Analyzer? They don't leave. That makes a big difference for me. Huge. And it will make the difference for you as well. Let's give it a second. Okay, this one, yes. On the Euro Yen, on the 10-minute it formed. And they formed right out the gate. So that's why I'm saying sometimes you'll get some alerts on the 15, the 10-minute, or the 30-minute. This was not a great move, but it was a move. You could have taken it. You could have taken it as soon as it traded below this level. Your outcome, 34 pips. You know, it wasn't. I prefer them on the higher time frames myself, but I'll look at them on, if I'm trading a specific session and they form on the 10, 15, or 30, I'll take them. Why? Because they're important. They're telling you that there's a potential trade. If it forms on the 10 and 15 minute, you're looking at a trade that'll take maybe 2, maybe 3 hours max. But if if they form on the 30 minute, then you know that that's going to take a lot longer. And so you don't have to be as concerned about the outcome. Let's wait for the 15 minute to formulate. Okay, see here on the 15 minute, we didn't get anything. It formed on the 10 minute, but nothing on the 15. And on the 30, we didn't get anything as well. Give it a second. So it's a matter of preference, you know. Depending on the session that you're trading, you can put it on the 10, the 15, or the 30 minute, the market analyzer. And that will determine your risk. I like the 30 minute. If I see them form on the 30 minute, I feel more comfortable with those trades. If I'm trading a specific session, you know, I'll scroll down, of course, and if I find them on the lower time frames, then I know that they're of the same importance. Yeah, see, nothing on the 30 minute. We looked at it, but it did form here and it did form here, but nothing here. So the fact that it formed on the 10 minutes here validated that they were no longer coming up here and that they were going to drive price down. Good trade to take. It was, the outcome was conservative but positive in your favor. And that's really much all I have to show for today, unless you guys have any questions. This would be the moment. Any questions on the market analyzer that you may want to ask? We'll change this to a 15 minute now. You can even do it on a 20 minute if you wanted to. I'll show you right now. This is the one thing that NinjaTrader has great, which gives us the ability to make changes accordingly to get these alerts. And the fact that you can program them to text you or to email you. Here, for instance, let's take a look at the Euro USD. Or no, let's see this one. This one is the US CAD. Yeah, let's take a look at the US CAD. This is one that normally people don't like to look at. And this will be the last pair that we look at. minute. And we put it on the 20-minute time frame. Okay. So here we have power dots on the 30-minute. Right below this level, right below this level. Is this a valid trade to the upside? The answer is yes. A very valid trade to the upside. Now, what's the problem with this trade right now? That on the 60-minute, this level was formed. And so they did come up to it, and now they're coming right back down to it. This would have been an utterly conservative trade with very high risk, because as you see, it went up, came right back down. Now, if we would have seen price action drive candles above this level, and this, let's say this one would have come up here and the next candle would start to go, then I tell you, okay, this trade will go up. But the fact that this candle didn't even go up to challenge it, and then this one is right here, this isn't going up, but the signal was there. Good signal, just bad follow through. Now let's look at the 20-minute on this one. Since we put the value of 20 minutes on the alerts on the market analyzer. Like I said, this is not a complicated software. The platform, very easy, very user-friendly. It's going to take a little time to learn, but believe me when I tell you, it is really, really advantageous, because now you just have much more ability to look at trades. See, this is a 20-minute right here. Look at how many dots they formed here. And you have a pivot. Granted, again, they did go up, but excuse me, right now, there is nothing telling me to take this to the upside. It's just the volume and liquidity are very low right now, and this isn't a really aggressive pair. I mean, this one moves, you know, very little. If we measure, for instance, the distance from here to here, you'll see that that was only 26 pips. Not a very conservative currency pair to trade. However, I think that there's a lot of risk in those 26 pips in that range as well. So it all depends on your comfort level. You can start with pairs that don't move aggressively, and that's fine. But again, you have to know the risk involved at that point. So here, would I take this trade long right now? I would be very I would say no. Now, if it was a more aggressive pair, then I'd say yes. Why? Because we have all the details telling us that this trade is going to go long. And the fact that it's on the 30-minute tells you that it's going to go long for a while. But, you know, for 26 pips, and with oil prices, this being commodity-based, I would sort of be patient and wait. So that's pretty much all she wrote for today, gentlemen. I hope that you had a good week. I hope that this makes a difference for you in your trading decision. And if you have any questions, you can send me an email, and I will be more than happy to answer that for you. Let me put it down here in the chat box. Or you can give me a call, and the number is there. So that's all she wrote. I want to thank you very much. Have a great day, have a great weekend, and we will see you Monday morning. Take care now.